Well, the risk rally rolled on last week with the S&P 500 notching its fifth straight weekly advance and the Nasdaq 100 closing Friday at a fresh record high. Meanwhile, treasuries trod water amid a lack of catalysts, while the dollar and G10FX more broadly also stayed well within recent ranges. A somewhat quieter economic calendar awaits this week, with a bit of a lack of tier one event risk looking across the globe, though inflation figures will be in focus with the latest price data due from Australia, the United States and the Eurozone. And of course, markets also continuing to digest news of that snap UK general election on the 4th of July. Plenty for us to discuss on the Trade-off UK this week. Without further ado, let's crack on with the show. So a lot for us to discuss on the trade-off this week. It is nice to be back here in the UK to discuss it all. As always, joining me is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, how are you this morning? I trust you had an enjoyable, albeit busy, bank holiday weekend.
Yeah, back here, had a bit of a busy one, but it's nice to get that extra day weekend in. So yeah, all nice and relaxed and ready to go.
Indeed, ready and raring to go to attack another trading week, albeit one that at face value appears that it might be a little bit quieter, and I've now said the dreaded Q word, but a little bit perhaps more tranquil than the last couple of weeks, I suppose.
Yeah, well, hopefully you give that the kiss of death, mate, and we'll get a nice busy one.
If vol now surges, you all know exactly who to blame. So before I put my foot in it once again, let's move on to topical thunder. So I said we're going to move on to safer ground. I'm not sure that's exactly the case, because we're going to talk about the UK general election. I leave the country for just 1 week and political shambles and pantomime descends once again. Of course, as I'm sure everyone's aware at this point, we had that announcement last Wednesday from Rishi Sunak, the Prime Minister, of a snap general election, the UK going to head to the polls on the 4th of July. Typically, Independence Day is probably the quietest day of the year for the financial markets, but that's really put paid to that idea of putting your feet up on the 4th of July. I mean, looking at the current polls, and I'll bring you in a second, Ryan, of course, but it would appear that the result could be something of a foregone conclusion. I was looking at the polls this morning. Labour are kind of 20-ish points ahead, looking at most of the opinion polls, and seemingly on course, if you apply that on a uniform national swing, for a pretty significant majority once the polls close at 10 o'clock in the evening on the 4th of July. Now, you'd expect that those polls are going to narrow as the campaign rolls on, but the gap is a vast one for Rishi Sunak and the Conservatives to make up. I think common rule of thumb is that within a campaign, you can generally expect to make up somewhere between 7 and 10 points, albeit during what is a very, very long campaign. It's going to be 6 weeks long. But I think for financial markets, what is perhaps more important, and from a macro point of view at least, is that actually there's relatively little difference seemingly between the two parties when it comes to economic policy. And this is primarily because both parties have subscribed to the same set of fiscal rules per the OBR's forecasts to have debt falling as a percentage of GDP in the fifth year of that forecast horizon. And the headroom in order to meet those fiscal rules is very, very limited. In the budget in March, the Chancellor Jeremy Hunt met them with about £9 billion worth of headroom. If even now that we've moved into a new tax year, you're still talking about a tiny kind of 18-20 billion pounds worth of headroom. So the room to maneuver on fiscal policy, particularly in terms of loosening fiscal policy, is very, very limited no matter who gets into number 10. And I think that's perhaps one reason why markets have largely taken this in their stride. Now, of course, there are some risks for the pound. I think the biggest downside risk is that those polls do narrow enough to the degree where we end up with a hung parliament and we could end up with protracted coalition negotiations. The biggest upside risk is that we end up with a Tory majority, although I think it's unlikely that we end up, given the current state of play, in either of those risk events actually panning out. Of course, it is worth bearing in mind that we are likely to see a bit of an increase in sterling volatility and, of course, a bit of an increase in sterling hedging activity as polling day nears and as those risks do come onto the horizon a little bit more. So I guess, Ryan, the big question I want to ask you is, is this all a foregone conclusion, and are UK assets right to just not really care?
Is it a foregone conclusion? On paper, it should be a foregone conclusion. Labour should clean up, but as we know, things rarely go to what they should be, or what a lot of people reckon. So I think there's several risks for this. I think a hung parliament is perhaps a bigger risk than a lot are making out. I think there's going to be a lot of voter apathy at this election, so we could see numbers of people voting well down. We could see a lot of protest voting. Yes, a lot of people have the right hump with the Conservatives at the moment, but is that enough to swing them to vote for another party? So I always tend to look at what might be the worst case outcome and plan for that. Everything else is sort of a bonus. So I'll be sort of thinking that we might get a bit of a mess and a hung parliament. The best news that came of it all is that we get no Bank of England speakers all the way through until the election, but we do still get the June MPC meeting, but no appearances from any of them until July the 4th or till the Bank of England, and I'm thankful for that, one thing.
Yes, I think we should all be thankful for that, although I would note that they've already broken that promise, because Deputy Governor Broadbent had a sort of valedictory interview in the Times this morning. So we'll see how long that one lasts. Of course, though, it is a busy year of elections this year. I think something along the lines of 60-odd countries hosting elections this year, plus, of course, European Parliament elections coming up later this month. But in the here and now, another big election this week down in South Africa, right?
Yeah, politics at play over there in Africa, South Africa, the general election there, that happening on Wednesday, with results coming out towards the weekend, over the weekend, next weekend. Now, there's three main parties in the running and one new one that may cause some waves. Firstly, we've got the ruling ANC party. They've been in power since 1994, but support has been really dwindling over, increasing corruption, declining the state of infrastructure, a lot of it resulting from mismanagement. So they have been losing a bit of steam over there. Then we have the Democratic Alliance, which has sort of seen many guises over the years. They've had various splits and mergers to come around to what they are now. But it's grown in popularity as the main opposition party. It does stand in very good stead when it comes to delivering services to the communities that it governs. But it hasn't done so well in areas where it's been in coalition leadership with other parties. The third party is called the Economic Freedom Fighters, and they're a bit more of a radical and militant, maybe a bit more extremist party. But they're unlikely to be winners, but the market might take notice if they score well enough to be an influence in any sort of coalition. Then really the outlier party is the MK party. It's a party that's been around quite a while, but they really come to prominence when the former president, Jacob Zuma, joined, and he dragged a load of his old cronies over from the ANC to that as well. So again, it could be a big player in any coalition. Although Zuma's been banned for running for parliament because of, again, other issues, corruption issues and the like at the ANC. So he won't be running. But as I said, he's pulled a lot of his old people from his old party, this one, and they're picking up quite a decent amount of support. Now, for markets, the ANC losing its majority or getting less than 50% of the vote would likely be negative for the Rand and other South African assets. And then it's a case of who might join in any coalition. A party like the EFF might be seen as a bit feisty for investors, whereas one of the more moderate parties might be more appealing. So if the ANC do keep their majority, it's likely to be business as usual for the politics, but also for the state of the country, which isn't really in the best of conditions right now. So for me, it's likely that any Rand positivity from the elections, I think it washes out later on after we've got over that sort of hump, and then it's sort of back to business as usual.
Yes, very good. We found Ryan's new specialist subject. It's no longer the Bank of Japan and yen intervention. It's now South African politics. We'll be sending you down to Johannesburg next week, mate. I do think
that'd be nice. Well, get a first-class flight for that one, and Yeah, quite like a bit of South Africa.
Yeah, good luck with the first class. Anyway, I think it does speak to a broader point, which, I alluded to a second ago. And, we talk a lot, or we have spoken a lot about the summer of easing in terms of monetary policy. I guess it's also the summer of politics for financial markets. We've got the election in South Africa this week, as you said. I think we get the Indian election results sometime next week. We've then got EU Parliament elections the following weekend. And then, of course, Independence Day, we've got elections here in the UK as well. So I think it's going to be interesting to see how political events begin to drive financial markets. I don't expect any of those to have sort of broader macro implications, but certainly for local domestic assets, they are key catalysts that if you're trading the Rand or if you're trading Indian equities or whatever it may be, very, very important indeed to have those on the radar.
Yeah, I think it's the easy way to look at these things if you're outside the country involved and you're trading those sort of assets is has things stayed the same? Is there certainty or is there uncertainty? Foreign investors don't like uncertainty. So if it's a landslide victory for one party or another or no big changes, then things tend to carry on. But you get the volatility if something has changed in those elections that the market wasn't going to be aware of.
Yes, agreed. I think that's definitely the best way to look at it. But of course, it's not just a case of, is there change? Because there's probably going to be change here in the UK. And I think markets will absorb that relatively well. As you said at the tail end of that, it's relative to market expectations and what's already discounted. That's the pivotal piece of the jigsaw. In any case, let's get back to the macro. It is a relatively light week of economic releases this week, but we do have a few inflation prints in the mix nonetheless. Australia kicking things off actually in the early hours of Wednesday morning, tomorrow morning. I must give Mr. Chris Weston some credit here because I actually entirely forgot that this piece of data was coming out until he gave me a bit of a prod on Sunday morning. Headline CPI expected to fall modestly to 3.4% on an annual basis in April from 3.5% in March. That would take us back to the level that we saw between December and February in terms of headline inflation in Australia. But it is interesting, and I was reading this, I believe it was from Morgan Stanley, the way that Australia calculate their monthly inflation figures is that earlier in the quarter, the basket is much more heavily tilted towards goods, and then the services figures come in as the quarter progresses, which has the effect of dragging the headline metric a little bit lower. So if we do see that come in cool, then perhaps that would be a risk that the figures are somewhat distorted. In any case, the market pricing in just 8 basis points worth of cuts from the RBA by the end of 2024, which seems a little bit underdone compared to other G10 central banks. So perhaps some room for a dovish repricing there. And then as we move towards the back end of the week, we get figures from the Eurozone on Friday morning, the flash CPI figures. Headline CPI expected to, or HICP, I should say, expected to tick marginally higher to 2.5% from 2.4% previously. The core figure expected unchanged at 2.7% on an annual basis. The ECB are pretty much nailed on for their first 25 basis point cut at next Thursday's meeting. But I think the market really now starting to think about what comes next. We've heard from, the French central bank chief Villeroy yesterday saying that they could even cut again in July. I certainly don't think that is a consensus view among governing council members. You'd probably be looking at September for the second cut. But markets have continued that hawkish repricing that we talked about last week, and now price just under 60 basis points worth of easing between now and the end of 2024. So God help us, Christine Lagarde's guidance on that one is going to be very, very key, and markets are going to hang on every word from the permatand one, which always ends well. And then, of course, on Friday afternoon, we get the latest PCE figures from the United States, this data referencing April. We're expecting the core PCE deflator to remain unchanged at 2.8% on the year, down to 0.2 from 0.3% on the month. I don't anticipate this being a huge market event because you can extrapolate the PCE data quite easily from the CPI and the PPI figures that we've already had released. But I think it will just help to reinforce the message that we are seeing continued disinflation, but relatively slow disinflation and not enough of a series of data points to prove a trend and give the Fed that confidence they need of inflation returning back towards that 2% target. And of course, if you look at US money markets, we see around an 80% chance of a 25 basis point cut in November, but that cut not fully priced until the last FOMC meeting of the year in December. So plenty of inflation data for markets to get their teeth into this week, Mike.
Yeah, absolutely. And let's start with the RBA. You know, they're not my most favourite central banker. They weren't supposed to be hiking rates until this year.
Are there any of them? Do you like any of them?
No. They've all got their faults. They can't get a forecast right for love nor money. But yeah, I mean, the RBA, they've kept their hike bias in every meeting. They say they discussed rate hikes, but decided that they're going to stay on hold and the like. So, you know, they're always ready to flip flop as the need arises. Same with the RBNZ, which we're going to talk about shortly. So, yeah, irrespective of what numbers get thrown in, like you say, the drag from services number coming into it, numbers are going to be what they are. The market will react either way. So if they're hotter than expected, obviously, we're going to price out those cuts and maybe start to get a bit more hawkish again. And obviously, the Aussie dollar is going to swing with that. Eurozone, we've had 2 months now at 2.4%, so it's right close to target, 2%. It's going to take a real big number to derail a June cut. So really what we are going to be trading is whether we follow up with a July cut or whether it gets pushed out to, you know, like I say, September. And they like to do these things at the forecast meeting. So it's really September and December after that. I don't think there's anything going to derail this really. Of course, if we get inflation moving closer to 2% in the next number this week, then that's probably going to increase odds for July cut, irrespective of what the central banks say thereafter. So again, that's going to be some movement for the euro as well. And on PCE on Friday, it's the Fed's preferred measure. We did hear from, I think it was Nick, our mate Timmy Leaks, Nick Timiraeus at the Wall Street Journal, saying that some of the metrics could be pointing to core PCE coming in around 3.2% or something like that. So there may be a little bit of surprise in those numbers. So, you know, I don't think it's a foregone conclusion, but as usual, anything that's hotter than expected, and we're going to be playing that higher for longer game and pushing out those cuts further down the year. And we should be expecting the dots to change when we get the next FOMC.
Yes, indeed. And I think most, including myself, are expecting those dots to move from 75 bips of cuts this year up to 50. But I think the market has, well, as we said, pretty well discounted that at the moment. In any case, let's move on. Ryan, you mentioned earlier that BOE speakers had cancelled all speeches and public statements and press conferences during the election campaign. I get the feeling you're trying to make up for that gap in BOE speak by having a bit of a chat yourself.
Yes, well, you know, like you said, we had Broadbent out, but he was reacting to being slagged off by Mervyn King, so that's why he took to the airwaves. But as for monetary policy speeches, yeah, they're potentially off the table. Though I don't know if we're still going to get any press speeches after the June Bank of England meeting, whether, you know, Bailey will hit the wires after, as he tends to do, hit the media just to explain away the decision. But anyway, as we're fond of highlighting, most of the market moves we see in relation to central banks are about fine-tuning expectations for monetary policy. And then once that course is known, the actual monetary policy change is really no shock to markets. We can obviously use the ECB as one example where we all know that they're going to be cutting in June. So there's going to be little market reaction when they do that. It'll only be on the forward guidance for future cuts where we'll get the moves. So for the Bank of England, I do feel we are in a bit of a situation where the market is still guessing, and maybe it's guessing too far one way. We've seen nothing but banks and institutions moving their cut forecast from June to August, even when the last week or so we've been getting data and forward-looking indicators that suggest that the case for June cut is actually growing. And as someone who was predicting that they wouldn't cut till August, I'm seeing June coming more and more on the table myself. Last week's CPI was an upside miss, but it was still down a huge amount, dropping to 2.3%. And with another big cut in the energy price cap coming in July, that could be another big kicker for CPI. Now, we know that there's some offsetting info to look at too. We've got strong wages and those price caps will be going back up in the winter. But the Bank of England made it very clear they're desperate to cut, and with one more inflation print a day before their next meeting, the June meeting, we could have CPI under 2%. Now, as they are one of these banks that said that they could cut with CPI on the way to target rather than waiting until it's at target, they do have enough evidence, in my opinion, to cut in June. So with the market moving wholesale to August, there's a growing risk that the market might be caught slightly offside if they do cut in June. And that's something us quid traders will need to keep an eye on.
Blimey, this is awkward, isn't it? You know, we're going opposite directions here. You've been saying for months they won't cut until August, and now you're coming back to June. I've been saying for months that they're going to go in June, and I'm now pushing that back to August.
Oh, really? You're moving?
Yeah, I think the key thing for me was that not only did headline CPI surprise to the upside of market expectations, it was also hotter than the BOE had forecast in the May monetary policy report. And coupled with that, you've got the services print was also hotter than the BOE had forecast. Wage growth is again a little bit hotter than they forecast, up at near 6%. And I think now you've got the election in the mix as well. There's plenty there to just push them into a little bit more of a cautious stance than perhaps we would have otherwise expected. Maybe we'll see another dissenter vote in favour of a cut at the June meeting. We end up with 6-3 for a hold rather than 7-2. I certainly wouldn't rule it out. I mean, as you rightly said, we get that next CPI print. The May CPI print comes the day before the MPC announcement, the day of the MPC vote, because of course they vote on the Wednesday evening. So I don't think we can rule out a rate cut at the June meeting. But in terms of, probability, I think if you'd have asked me this time last week, I was kind of 75-25 in favour of a June cut. I think I'd flip that around now and say 75-25 that they actually go in August instead.
Yeah, I mean, this is one of the strange things. You've highlighted the reasons why it should be August, and those are the reasons why I was pumping for August. But, I see them really so desperate that they want to cut. I'll ask you the question: what happens if we get to the June meeting and we get that CPI on the 19th, the day before, and it comes in at 2% or 1.9, 1.8%, and that's with this energy price cap cut to come? That could be inflation down at 1.5% by August. What happens then? Do they cut in June? Are they going to wait for that last minute data, or do you think they've already maybe pushed themselves to August themselves?
Well, I think and we will move on in a second, but I think in many ways this cancellation of all public remarks is actually going to help the BOE, because it means that, we've now had that hotter than expected inflation data, but we don't have to hear from them. They don't all have to clamour to get in front of a microphone to try and explain it and explain how that impacts their reaction function. And almost that silence gives them a little bit of room to manoeuvre. I think, if that May inflation print is 2 or below, then absolutely a cut is firmly on the table for the June MPC. And I don't think they're going to let politics get in the way of that, because for some time now, the BOE have been signalling that the next move in bank rate is going to be a cut. They've said that for most of this year, and we've had people on the MPC DINGRA voting for a rate cut since last year. So I don't think they're going to let the fact that there's an election prevent them from cutting. But I do think we would need to see some fairly chunky progress on disinflation in that May number, or some significant labour market weakness, of course, in order for the cut to be on the table in June. But I think the chances are that they do go in August at this point. So your pendulum, to use your analogy, going one way, mine going the complete other way. But I do want to have a look at the pound and discuss cable in That's a Setup. I'm also going to start a petition to rename this segment, because I forget the name of it every week. So if anyone's got any ideas, comment below. I'm all ears, as long as it's easy for me to remember. Cable is what I want to talk about first of all. As we were just saying, the market paying very, very close attention to what the BOE are likely to do next. If I'm being completely honest, I don't have a massively obvious bias here when you look at sterling against the dollar. The G10 FX market has become a little bit tedious tedious of late, and cable is grinding slowly but surely higher amid that tedium, with spot touching its best level since late March of last week. Although that 125 to 128 range that, besides that move lower in mid-April, has held for the last 7 months or so, remains in place. I would be a little bit inclined to sell rallies if we get towards the top of that range. I think, as we said, there are a few downside risks facing the pound. Of course, you have this political uncertainty that's now hanging over things as we move into election season. And of course, you've also got the risk in terms of the BOE. We've had that big hawkish repricing, as Ryan and I were just alluding to. We've now got just 33 basis points worth of cuts priced by the end of the year. So I do think perhaps there is a risk that the June decision becomes a little bit more even in terms of the market's mind. I don't think this is one to get particularly greedy with, though, given the relatively low volatility that we see across the board. But if we do get any moves up towards that 128 or 128.50 level, then that may be somewhere where I'd be looking to fade some of the strength that we're seeing in the pound.
Yeah, well, it's funny because I actually went long on this pair right over the Bank of England last meeting down in 124.5. I'm still a little bit on that. I'm just sitting on and riding for all it's worth. And yeah, this is the thing with cable. You know, if it decides to move and starts to grind, then you know, you shut your eyes open and blink, and it's 200 pips higher. Yeah, I think this is one pair that's the pound pair that's at risk for if we do get a June surprise cut. Because that will obviously narrow the difference or the divergence with the US, the UK rates coming down while US rates stay up. So yeah, that could be something that we see the pound dip. But the dollar side of this trade is always going to be the stronger one. So, you know, even if we do see a dip in cable and then the Fed gets some data that prompt them to you know, start thinking about cuts seriously, then we're going to see a reaction probably other way and cable gaining. So yeah, for now, look at the range. We've got a range up at you know, next levels around 128, and then the bigger range edge at 130. And you know, we're not too far away from that, and cable can do that easily. So yeah, if we get up to that 130 area, then I suspect we're going to run into maybe a bit of trouble, and that might be a time for shorts to start looking at things.
Indeed, yes, we shall see what happens. Right, Ryan's obsession with South Africa continues, not the political situation this time, but the currency instead.
Yeah, well, I've spoken about the election, so it'd be a miss of me not to, or remiss of me not to have a look at the currency. Firstly, one might consider this pair to be fairly stable right now. It's been in a reasonably tight range for around a year, and this one can be a bit of a wild horse at times. Obviously, there's a big US dollar influence here, but it can also be a bit of a wild move on the rand side too, and it's a big commodity currency also, so that correlation looks to be fairly strong at the moment. We saw rand strength peaked last week via that move close to 18, and that coincided with copper and gold both peaking last week at their highs. So really for the rand here, I think one has to see if the election pushes the rand out of kilter with what's going on elsewhere. You know, for example, if commodities are still dropping from recent highs and the election brings some rand strength, that might be a counter trade to look at. Obviously, what's happening on the US side of things needs to be considered too. But again, if the US dollar is strong everywhere else and this one is dropping on a stronger rand, then again, that might be two factors that put it, you know, in the pot for a counter trade. On the flip side, if the election is a big old miss, then the rand weakening might just add some tailwind to this pair to push it back up maybe towards that 19s area. So from a technical standpoint, that 18 support has shown itself to be really, really solid, and as has the 38.2 fib just below that at 1743. So on the top side, 1930.40 has been the range high. We've had one quick extension back in October. So trading wise, we're closer to the low end, so I'll be watching that for a test and hold of the 18 level, perhaps with a view of getting long off it and then seeing if we can take a run up to the top of the range, or even selling a confirmation break of 18 for a short down towards that 50 fib again. So there's plenty here to trade. You don't have to pick a side, you can just react to the election and what moves happen.
Indeed, yes, good stuff as always. And I think, as you rightly said, there are some relatively strong and obvious predefined levels on the chart here. And I think the usual rules around elections apply. You know, if you do have rand exposures, or if it's something you're considering trading, then do expect higher levels of volatility and much wider trading ranges as and when those results drop and are discounted by the market. Of course, that presents potential trading opportunity, but also risk if you are running exposures into the event. So important to be aware of no matter which way you're looking at things. Speaking of volatility, that's what I want to get on to next, because it was, yesterday in the United States was Memorial Day. And of course, Memorial Day to Labor Day is traditionally what we would call summer, although that is, looking out the window here in London, a little bit of a foreign concept at the moment, about half as warm as it was this time last week for me. In any case, it seems like markets might have got the summer vibe a little bit early. What the hell are we looking at here? Because these charts look a little bit messy. Well, firstly, we're looking at the daily trading volume in the front month S&P 500 future, which if you look at the white line, which is the 15-day moving average of that volume, you can see we are not only falling at the lowest level since March, but continuing to decline, although, of course, the relatively quiet day yesterday will have skewed that data just a little bit. We're then looking at implied volatility via the VIX. The VIX trading with a 12 handle, pretty much at its lowest since 2019, all the way back before COVID. I think November 2019 is where the VIX is at its lowest level since at the moment. And then we're looking at actual volatility, or realized volatility, which is at a roughly 6-week low. What the hell does that all mean? Well, as we move into summer, of course, we tend to see fewer market participants trading. People have time away from their desks. They go on holidays. We also generally see lower levels of volatility. That steady grind lower in vol that we're seeing is likely to continue, and that in turn results in perhaps tighter trading ranges, which in the absence of any other catalysts should see the market continue to take the path of least resistance, which for equities seems to be higher at the moment, and for the FX market seems to remain within a range. But it's important also to remember that if we do see lower volatility, if we do see fewer participants trading, that also likely leads to poorer market liquidity, which if we do see unexpected news or data surprises or things of that ilk, you can tend to see much bigger and much more significant market moves than you would in quote unquote normal times. So I guess the message is that agility and being nimble remains key. Just because we're moving into summer and markets appear a little quieter, it doesn't mean that we can't see things move around pretty violently.
Yeah, I think that's very apt subject to talk about, mate. I'll speak about volatility a lot, and we have seen it dropping, particularly in FX. We've got the euro, for example, euro dollar, 1 month at the money vols, in danger of dipping below 5%, which takes it into very quiet territory. But like you say, that also means that if we do get a big event and we've got plenty of data to come and still central banks to resolve what they're going to do, that will inject some quick, fast volatility spikes. So if you get a big data miss or a big data beat, you're going to see a big move there as the market just rejigs those cut expectations. So yeah, it's a bit dangerous, because those type of moves, you think, oh, here we go, we're onto something here, and it lasts 10-15 minutes and then the market dies a death again. Yeah. So you've got to be careful. If you're on the right side of something, you've been in a position and you get, a decent move in your direction, that's probably a good time to think about just taking some partial profits, because then if the market does die after that, you're not back to watching paint dry and not taking any money in the bank. Conversely, don't get tied too deep into any trades. Stick to trading the ranges. We've got some good ranges forming. When it's quiet, markets like to range. The option vols can keep the price contained within a fairly tight range as well. So that's another opportunity to trade. So I think the key here is just adjust to the conditions. Okay, quieter markets require a different way of trading, and then you look to see when that volatility picks up again.
Absolutely. Sage advice as always. Why don't we continue that with your look at WTI?
Yep, looking at oil, and last week it seemed to be teasing a bit of a break. It looked like it was having a little wobble late last week, because it once again broke under the 50 fib around that 77.80 area, and it took a run lower. However, that break didn't last very long, and we put in a fairly strong rally to take us back above that fib late last week. Now that move really slammed into the 100 DMA, which has been capping for the last 3 trading days. and we've got the 200 daily moving average DMA. It's not too far above, and that's coming in pretty much in line with the old 38.2 fib. Now that's mostly capped things throughout the whole of May, so it's a bit of a resistance area you need to keep an eye on. Now, despite this bounce from the 50 fib, the new low from last week would suggest to me that if we did get another move under that 50 fib again fairly quickly, we're likely to see a sustained downside move, which could then target the 61.8 fib down at 75.5, 75.45. So for me, I'll be looking to sell another hold up near that 200 DMA around that $80.50 mark, or go with a short on another break of the 50 fib again. But on that side, though, I'd want to see another low below that prior low 76.85, or there would be a risk it holds again and bounces once more.
Yeah, I mean, it is starting to look pretty weak from a technical perspective. I mean, as you said, we did manage to sort of clamber our way back above that Fibonacci retracement, or the 50% retracement, I should say, towards the tail end of last week. But we're still capped by all of those key short, medium, and long-term moving averages that you got on your chart there. So you would say from that perspective that momentum is with the bears. I guess in terms of fundamental catalysts, you would argue at this point that crude, both Brent and WTI, is pretty much priced out, easy for me to say, all geopolitical risk at this stage. So in terms of catalysts, you're really looking to the demand side. We get some manufacturing figures. The PMI is out of China early hours of Friday morning. It's the official data, so take it with a pinch of salt. But if we do see continued signs of improvement, then perhaps that could be a little bit of a fillip for price. And then, of course, we expect OPEC to roll over their output cuts when they meet at the weekend as well. So a few moving parts, but yeah, I agree with you. I think the path of least resistance is to the downside, and in terms of selling rallies for the moment.
Yeah, I think so. And that OPEC, unless there's a real surprise from that OPEC meeting, then again, this could be another one that's business as usual.
Yes, indeed. I think the fact that they've moved that online as a virtual meeting says it all. They've probably already agreed that they're just going to rubber stamp an extension of those cuts. Right. In any case, let's move on to our plays of the day. I want to kick things off with a look at the FTSE 100 back in the UK this week, and still looking for ways to express a long risk view. As I said earlier in the introduction to the show, equities are continuing to rally strongly on Wall Street. We've seen the market come off the boil just a little bit here in London. We're still up around about 8% year to date, which certainly isn't too shabby, but the FTSE 100 has come around 2.5% off the all-time high that we saw just shy of 8,500 a few weeks ago. And sticking really with my long-standing strategy of buying into weakness and buying into dips in equities as and when we see them, I think this is as good an opportunity as any to buy the dip in the FTSE, particularly with the London market still looking relatively cheap compared to global peers. And in terms of targets, well, the prior all-time high around the 8,500 handle, that remains the obvious target. So that is what I would be looking to do this week. Long the FTSE, buying the dip. Ryan, you're going down under, I believe.
Yep, going down under, and a bit of a tech confluence trade for this one. Last week, the RBNZ took a very big leap back into the hawkish camp, which surprised a lot of Kiwi traders. Now, matching that up against a sidelined RBA, this saw Aussie Kiwi dipping back towards our old mate, that old magnet down at the 108 level. This is a level we just can't seem to stray far from for any real length of time. This time, though, we have a fair bit of tech confluence down there. We have obviously the big figure 108, both the 100 and 200 daily moving averages, and a longer term trend line coming just across that level as well. So all of this is in the same place, and that's a good amount of tech for me to have me thinking about a long right into the big figure with a tight stop just under that yellow trend line.
Good stuff. Well, we can shorten the timer on these. We've got through those so quickly this week. Right, that does indeed bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as always. It was great to catch up with him in Dubai last week. Thank you also for watching. Hopefully you've enjoyed the show. If you have, please drop a like on the video. Leave a comment as well. If there's anything you'd like us to discuss next week, or your thoughts on how the markets are evolving at the moment, then we would love to hear them. And we will indeed be back next week with another episode of The Trade-Off to digest everything that's going on and look ahead to what I think will be a very busy start to June. Of course, we've got an ECB decision on the 6th and then the latest US jobs report on the 7th to keep us on our toes. In the meantime, thanks again for watching. Goodbye for now.